Hello, Matthew Bell with InsurancePrescription.com, and today I want to talk a little bit about life insurance riders. So the simplest definition of life insurance rider is just going to be an add-on, something that you add into the policy that's going to give you something a little bit extra. Now the benefit of these are that they're going to enable a person to customize a policy. They're going to enable you to do things with your policy that might be unique to your situation that the generic policy simply doesn't do well or doesn't do at all. I'll give you a few examples of those in just a minute. Now the downside is that they can often add cost to the policy, and sometimes they add a fair bit of complexity. Now most of them are going to be fairly low cost, but they will add on something onto the regular premium. So you're going to have a base premium, and then you're going to have riders attached to the policy that are going to have their own premiums associated with those, or rider charges. But they can add something a little bit new, they add something a little bit extra to the policy, or they amend the contract in some way that is beneficial. And that's basically the legal definition. They're going to be amendments that are going to change the way the basic terms, the basic parameters of the life insurance contract works. And it is a contract, after all, between the insured person and the insurance company. Now, of course, you have to weigh the complexity of the rider, the cost of the rider, against the possible benefits to determine whether any of these might be useful for you. I'm just going to sketch a few random examples here just to give you a flavor for what a rider is. So one common rider would be an accelerated death benefit rider. In this kind of a rider, which basically comes in several different forms, you can have it in the form of a chronic illness rider or a long-term care rider. You could have it in the form of some kind of a terminal illness rider. This is going to enable the insured person to have access to the death benefit in advance of death. So in other words, with a life insurance contract, obviously the death benefit is the benefit that's paid when the insured dies. But if there's an accelerated death benefit, that means that a portion of the death benefit is going to be accessible under certain conditions before the death of the insured person. So take a terminal illness rider, for instance. Depending on the kind of contract, the percentages might vary. It could be 25%, 50% of the death benefit, 75%, 90% of the death benefit. But whatever it is, the idea behind the terminal illness rider is that if the insured is diagnosed with a terminal illness, that is to say, an illness that is likely to result in the insured's death, usually within a very compressed interval, 6 months, 1 year, 2 years, then you have access under that rider to some of the death benefit in advance. Now, there are pluses and again minuses to any of these riders. So a plus is going to be, it can be a game changer when you're trying to get your affairs in order. If you've been diagnosed with a terminal illness, to have access to some of that death benefit money can be a game changer for your family and for your plans. The negative side of it, though, is it is going to offset the amount of insurance that is going to be left for your beneficiaries, your survivors, and so on. So generally, when you set a policy up, many times life insurance policy is designed with the express intent of leaving a certain amount of money on to a certain beneficiary. And if you tap into that death benefit in advance for yourself, then you are decreasing the amount of money left over for your beneficiaries. Now sometimes that's okay, and sometimes the policy can even be put in place with that eventuality in mind. So if you bought the policy to exercise that rider, then absolutely take advantage of it. It's not to say you shouldn't take advantage of it even if you didn't buy the policy expressly to do so, but you should weigh your options, and that would be done in conjunction with an actual insurance agent or other financial planner, somebody who understands the particulars of your situation and can advise you appropriately. This video, I should say, is purely for informational or entertainment purposes only. I cannot give you advice in these matters, and I am only suggesting areas where you might want to do a little more investigation on your own. Now, another kind of accelerated death benefit rider can be a chronic illness or a long-term care rider. Once again, these are similar to the terminal illness rider, except they differ in their trigger. So whereas a terminal illness rider, for a person to be benefit eligible, you're going to have to throw the trigger of being diagnosed with a terminal illness. In the case of a long-term care or a chronic illness rider, the trigger is simply going to be for some kind of a long-term care needy condition or for some kind of a chronic illness. So generally, and I go into this more in depth in other places, that's going to be lacking 2 out of 6 activities of daily living on the physical side, not being able to bathe yourself, feed yourself, dress yourself, get in and out of bed by yourself or transfer, toilet by yourself, or to be able to maintain continence. And on the cognitive side, it would be having some kind of a mental disability, mental impairment, like Alzheimer's, some form of dementia, that is going to require you to have constant supervision in order not to be a danger to yourself or to other people. So if one of those two triggers or a combination is in force, according to doctor certification, then you would be eligible under this rider for acceleration of your death benefit. Same kind of a thing, the percentage available is going to differ, and you should bear in mind that sometimes these riders are funded differently. So sometimes you might have a long-term care rider that you actually pay for in an ongoing way, whether you use the rider or not. And in other cases, there can be a kind of a discount that's applied in the event that you need an acceleration. If your rider is set up like that, you don't actually pay a charge ongoing. What happens is part of the death benefit that's accelerated to you is discounted. So just to take a random example, let's say you have a $100,000 policy and you have a discount applied to your death benefit. Well, let's say that whatever condition, terminal illness, chronic illness, maybe you have access to 50% of the death benefit. So in principle, you have access to $50,000 ahead of your death in order to discharge whatever obligations, whether they be medical or other, that are applicable to your situation. So if you have a discount applied, then that 50%, $50,000 would be given to you, but it would be reduced by whatever the discount is. Let's just say $15,000 is taken off, so you actually get $35,000. Now your death benefit is reduced by $50,000, but you actually only get $35,000. Now, not all riders work this way. Some you pay for on an ongoing way, but whenever the rider is included at no cost, generally the cost is taken out in the event that you use it. So you want to just understand the kinds of riders that are available to you and how they work. Another kind of rider, very different, is going to be a conversion rider. Now this is going to apply to term insurance. Term insurance is temporary insurance. It's in place for 10 years, for 20 years. Well, a conversion rider, when one is available, enables you to convert or to transform all or part of that term policy into a permanent policy. So you'd be able to get universal life or whole life insurance by doing a term conversion. If that rider is available to you, the main benefit of it is you don't have to go through underwriting. So let's say you get a term policy, and 10 years down the road, you develop some kind of a health condition. Well, you have the ability to convert your term policy, let's say, then you can do that conversion without any additional underwriting. Your health condition is irrelevant. The negative, as it comes with most of these riders, is you're going to pay for that option. So you want to try and anticipate whether that option would be of interest to you. If you think you have absolutely no interest whatsoever in converting a term policy in the future, then paying for a term conversion rider would be worse than useless. It would be a waste of your money. But for those people who want to protect their future insurability, or who for some other reason think they might have a place for whole life or some other permanent insurance in their portfolio long term, it can be a very good way to secure that option in the future. Another rider or constellation of riders are going to be having to do with disability. Sometimes you can have disability income riders, which are going to provide that a benefit be paid out while you are alive if you are disabled. So if you, for example, can no longer go to your gainful job and receive your paycheck, a disability insurance rider might provide that as part, might provide a monthly benefit as part of your life insurance policy. Now there are also disability income policies separately, so some of the differences, maybe in a rider you can only get 2 years worth of coverage, where if you have a separate disability income policy, it might carry you all the way out to retirement age. So there are differences. Another kind of rider is going to be called a disability waiver. That is also sometimes called a waiver of premium rider. And on this rider, if you become disabled, then the insurance company will no longer require that you make premium payments. Often, the insurance company itself will continue to make premium payments to make sure that the policy's funding is self-completing. This can be extraordinarily helpful. If you lose your ability to work, life insurance or insurance is sometimes some of the first things to get cut, but in the event that you are protected with a disability waiver, you don't have to worry about cutting that precious coverage, which compounds a problem if you are disabled not receiving a paycheck. That problem would be compounded if you also then have to lose on some of these long-term protections. So a disability waiver, usually fairly low cost in comparison to some other riders, and it can be a very good option for people who want to try and make sure that regardless of what happens to them, that insurance policy is likely to be in place as it was designed to be in place. Another rider is going to be a return of premium rider. Now this is going to be a rider that is attached also to a term policy, similarly to the conversion rider. And in a return of premium rider, this is somewhat of a surrogate for having a cash value. So in a permanent policy, there is a cash value kind of an equity that builds as you make payments and as the company perhaps is dividend paying, pays dividends into the policy. There's a cash value component. On term policies, however, there's no cash value component. You're paying for pure insurance coverage. That means that if you don't end up using the policy, and some statistics vary, but they range from 1-2% maybe of policies that actually do pay out in terms of term. So the majority of policies, it is suspected that are term, are not going to pay out. And sometimes that's okay. If you are getting the term policy because you are trying to keep pace with your mortgage payment, when the mortgage is paid off, you don't need the term policy anymore, if that's what it was for. But for other people, that diminishment of coverage or that diminution of coverage is going to be detrimental to their long-term plans. For some people, the prospect of paying into a policy that there's very little chance they'll use is a waste of money. And so return of premium is a way for them to preserve the idea of term insurance. So they're not going to a whole life insurance policy, but at the same time, it provides that premiums will be returned if the policy period is served without the insured dying. So for instance, if you have a 20-year term policy, let's say $1 million policy, and you live the 20 years, obviously if you die within the 20-year period, your beneficiary will receive the $1 million proceed. But if you live through that entire period, then a return of premium rider provides that the money you paid in, or at least part of it, is going to be returned to you. So your premium will be refunded to you. Now, that rider is one of the more expensive riders because essentially the insurance company is guaranteeing you to either return your premiums or to pay out $1 million. And so that rider is fairly costly compared to some others, such as the waiver of premium rider. Now, the exact cost of these riders, again, is going to vary. Whether they're going to be helpful for you and your family is also going to be something that would only come up in conversation. So I invite you to have a conversation with your insurance agent. Of course, I've just scratched the surface of riders. I mentioned that some riders can add complexity, and I really didn't give an example of a rider like that. Sometimes those riders are going to have to do with the way the policies are funded, and sometimes those can get fairly complicated, but they can also be of benefit to you. A final thing that I'll say here is sometimes one hears about an exclusion rider or an exclusionary rider. In the strictest sense, this isn't a rider, since a rider is something that adds coverage, but an exclusion is something that restricts or removes coverage, or if you want to say it subtracts coverage. So in healthcare, prior to the Affordable Care Act being passed, it was the case that maybe a health insurance policy would cover you for a lot, but if you had a pre-existing condition, then that condition was not covered. So if you had diabetes going in, maybe no diabetic treatment that you needed was going to be covered under that policy if you came into the policy with that condition. Now those have gone away with the Affordable Care Act, but in disability income insurance, for instance, if you have a back injury, you might have a disability policy that covers you from everything else that you might anticipate if you get cancer, if you get injured in some other way. But if you need the disability because of a bad back and that bad back is excluded from the policy, then the policy would not pay out in the event that your back triggered you to require the disability payment. In life insurance, there are also exclusions. One very common one is called a suicide exclusion. Nationwide, the suicide exclusion on average is about 2 years. Some states vary, they might be less, but in 2 years, basically the idea is that if the insured commits suicide within 2 years, then the insurance company generally is limited to a return of premium payments that were paid in terms of a limitation on their liability. In other words, if a person has an insurance policy and commits suicide within the suicide exclusion period, the policy death proceed does not pay out. Usually it's not the case that the money's just gone that was paid into the policy. Again, there's usually a refund of premium. But the idea is the death payment would not be the full death amount. Now, after that exclusion period has been served, then the death proceed would pay out even for a suicide. I hope something I said to you was of interest or value to you. If it was, I ask that you please like the video, click the subscription button, click the notification bell to be alerted to new content as it becomes available. I thank you so much for being with me today, and I look forward to seeing you again in another video. Thank you.